Welcome to the weekly wrap-up, where we take a look at what economic events were moving and shaking the markets this week. Today I'm joined on the line by Larry Hatheway, Chief Economist at UBS. So Larry, Spain has been making the headlines this week with riots in Spain, the Spanish budget, and Catalonia is looking to break away from Spain. What are your views on these events, and do you think this is only the beginning of the Spanish public rebelling against the government?
Well, to some extent, if you think about these in the context of the entire sort of program of austerity, the resulting recessions and so forth, it's only natural that we should expect a political resistance, a backlash, if you like, to what is happening. We have seen incumbent governments swept out of power elsewhere, including in Spain itself at the end of last year, as part of this sort of feeling of popular discontent with everything that is going on. However, the Spanish story has dimensions to it that are interesting and new. Amongst them, obviously, the differences in regions and the potential here of sort of separatist votes, first, of course, in Catalonia, as well as, of course, the issue there that the government has lost a lot of popularity, lost a lot of its mandate that came with it at the end of last year. And it's important from one other perspective, which is that policymakers in the rest of Europe have to be looking at this and thinking about what is feasible from not just an economic or financial point of view, but what's feasible politically, and therefore how might policies have to be adjusted to take into the realities of the political backdrop that we're now seeing unfold. And the area, I think, of concern has been within the Eurozone, has been whether the Spanish government would come forward both with a credible deficit reduction program, but also would be willing to agree to some kind of a memorandum of understanding with the ECB, with the IMF as an observer, that would allow the ECB to activate its new program of government securities purchases. So far, that's outstanding. To be sure, the Spanish government did deliver a budget that didn't really contain a great deal of surprises, is a fairly austere budget, has a fairly ambitious target in terms of deficit reduction, is probably in line with broadly what the EU expects of Spain to deliver by way of fiscal consolidation. So it may be paving the way for that agreement, and the markets did respond generally favorably to the presentation of that budget.
Also, the Greek coalition agreed on an austerity programme. What are your thoughts on this, and what is the situation in Greece like right now?
I think it is still a very fragile situation. There were some hopes, I think, in the course of recent weeks that there might be a little bit of give, as it were, from the Troika in terms of perhaps being a little bit more accommodating around some of the challenges that the Greek government faces. But I think there is also an element of not wanting to perhaps concede in areas where ultimately the Troika believes that Greece has to make these adjustments. I think over the course of the next couple of weeks, we're going to see difficulties. We're going to see potential sort of setbacks in the discussions and in the perceptions of the markets about whether Greece is going to be able to come up with a package that ultimately meets the terms that the Troika is setting out. But I also believe at the end that they will find a way to compromise between them. We'll see another Greek package, and then we'll move forward from there.
There was also data released this week about the US economy. How has this data affected the performance of the markets this week?
Well, the data have been mixed out of the U.S. We've tended to see, in terms of brighter areas, the housing market. That's been true now, actually, for the course of recent months, both in activity and in price terms. Consumer sentiment has improved, and it may be linked to the housing market. On the other hand, businesses still seem to be pretty reticent to spend. Durable goods orders have been weak, and overall their willingness to hire has not really come back in the same way that we saw it at the beginning of the year. So the weakness of the spring and early summer has only been partly sort of now reversed, as firms are still quite cautious. That last point is important. It seems as though perhaps the business community is worried about things like the outcome of the U.S. elections and what that means about the so-called fiscal cliff. They may also be concerned as they look across the Atlantic towards the Eurozone crisis or across the Pacific towards the fact that the Chinese economy is still not really performing as strongly as some had hoped. So this uneven picture of U.S. economic data probably is going to continue. beneath it is an economy that I think has done a fair amount of adjustment in terms of improving profitability, in terms of improving the household's balance sheet position and cash flows. And there's an economy that has some interesting sort of new stories to it around the energy revolution and some of the areas of technology that have been leading the U.S. economy in recent years. So I think there's a degree of resilience there, but there's also a sense of trepidation around the uncertainties of what policy might deliver.
And in general, how were the markets performing this week? And how do you think the markets will be performing next week?
Well, markets have sort of taken a bit of a pause, although there's been a bit of ebb and flow as well, but taken a bit of a pause from the stronger recovery of global equity markets and some of the so-called risk assets that had occurred through the months of August and through much of September. The pause was in part because of some of the concerns resurfacing in the Eurozone. And I think looking ahead to the coming week, the big issues for the markets will be mostly the U.S. data, the twin ISM reports. We have another employment report. So people want to see that the U.S. economy is perhaps making a little bit of recovery from the soft patch of the summer. I think that's going to be probably the key item for the week ahead.
Thank you very much, Larry, for discussing this week's events. Now, before we end today's weekly wrap-up, let's have a look at what some of our experts around the globe had to say. Brian Hilliard, Chief UK Economist for Societe Generale in London, spoke to Irina Harris-Dowdy about further policy stimulus for the UK, saying, "I think in November we will definitely get a 50 billion increase in QE, and I'm also forecasting a cut to the bank rate of 25 basis points." Elizabeth Holvik, Chief Economist at Sberbank 1 in Oslo, shared her views with Thomas Taplin on France's 2013 budget announcement, saying in order to reach their target next year of a 3% deficit, they would need to cut about €30 billion. And finally, Nicholas Spiro, Managing Director at Spiro Sovereign Strategy, told Monica Gibson Spain needs more austerity like a hole in the head. And that brings today's weekly wrap-up to an end. Keep up to date with the latest economic and forex news from the Dukascopy team. Have a good weekend.